Hey everybody, welcome back to another beautiful day in real estate. Today we're going to keep it short and simple. I've got some meetings popping up, but we're going to go through a few items today. As we've been talking about the last few days, we've been talking about how the economy is starting to show its cracks, and we're starting to get to the stress of potentially a market crash over the next 6 to 9 months. Now, as always, we'll jump into interest rates first. Interest rates, you guys, are still moving upwards slightly, and the reason is just because of the negotiation talks with Iran have been going poorly, or I guess they're being reported as poorly, but every other day we get a tweet or a true social post just stating that everything's fine, we're almost there, we're going to be there in a couple days, we always are, and then it crashes and then the market moves, right? So I'm finding out that about the mortgages usually follow about 24 hours after the bonds move. So I've noticed that, excuse me, I've noticed that on the 10-year bond, we saw a nice little spike yesterday, which and mortgage rates kind of sat where they were. And then today we see that spike down again, but interest rates actually moved slightly up. So that means that we're going to be paying attention to basically about a 24-hour delay for the actual the actual market moving. Now, everything's kind of finding, like this one right here, we're talking about the trend line for the 30-year bond here. We're going to go all the way back down here where this bottomed, which was right around September of 24. We saw one major move right here. The bond moved. This is right at the beginning of the war. So we saw right at the beginning of the war, we saw interest rates dropping. This is kind of where everything peaked, like reversed, right? So everything went down, everything kind of stopped here. And then after the war, everything kind of trickled up. This was a unique compared to the trend line. So yeah, there was a little bit, a little bit of a cancellation, however, a big unique event. Other than that, we've had a trend line where it's essentially followed its way all the way up. This, however, means to me, more than likely we're going to break below this here within the next few weeks. More than likely, we might touch at 5.18 again. I don't know, but we might even be a little lower, and then we'll break below this trend line. My guess is, based off of what we're seeing, they're focusing so much on ending the war in Iran, and the reason is I believe that there's too much oil reserves that are being strained across the world, and people have to find some sort of sustainability within it. Whether it doesn't matter what company you're in, really, or country, everybody kind of needs that strait to open up to continue to have transport for goods, services, and oil. But according to the bond market, it just looks like it's starting to prepare for a move down. You're not seeing a bunch of volatility moving up, especially, you're kind of falling down from that major resistance, turning it into support. So we kind of have to see, will we break below this, or are we going to stay right here? I'm going to say this is more of a resistance than support. So they might have to, right now, I guess the market's pricing in a support rate around that 4.43 range. I'm guessing we'll break below it, just depending on what the news says over the next couple of days. However, let's jump into the S&P 500. S&P 500 saw its peak yesterday as well, falling off, losing some gains this morning right away. I'm not seeing any news directly correlating to this right now. We're noticing we're having a blow off top, right? And it, just like a blow off, every blow off top, you have to see some sort of correction as well. Like it doesn't go straight up forever, but it will bounce down and essentially recover pretty quickly. It's already Thursday this week, which is crazy. It seems like the weeks are just flying by at this point. And oil is also kind of bouncing in between this channel as of right now, 94 to 88. I mean, you bounced pretty significantly, pretty close to, right at that 94 range, and then came back down. This was after basically the run up after Iran said they're no longer negotiating with the United States after some attacks happened over last weekend on both sides of the spectrum, right? It's not just one or the other, but both of them are saying, well, pointing fingers saying it's their fault, it's their fault, it's their fault, right? But really the reality is we continue a war that isn't quite over yet. And until we see some sustainability, again, there's not really major news saying that oil needs to go up. There's nothing saying it needs to go down. That's why it's consolidating between the two. I mean, this is kind of that perfect little channel to decide. The market will figure out what it needs to do sooner rather than later. But the Strait of Hormuz is supposed to be opening, within the next couple of weeks, it sounds like. I mean, they're not really giving us a time frame, but they are talking about it. Trump announced the Strait of Hormuz will be immediately open once he signs a memorandum of understanding with Iran. So the Hormuz Strait will open. We'll have our minesweepers there underwater. They're great, amazing tech. We've swept mines. We're gotten most of them. Great news for gas prices. So essentially, once this ends, they're anticipating, and Trump's saying that gas prices are just going to go the opposite direction. I mean, I don't necessarily trust that 100%, but it leads for hope, right? And I think that's a lot of people latch onto at this point is they need the hopium to kind of keep moving forward and feel like there is a light at the end of the tunnel, if that makes sense. And so here we are. Bitcoin dropped below 62 into the almost, I think it was close to the 50s this week. Let's see here. 63,000. Yeah. Let's see. 61K is our bottom as of right now. I mean, the bottom of the spectrum. So let's pull it up. So Bitcoin, it built it started building a bear flag and then it built a beautiful bear flag. And now we're seeing the repercussions of that. Let's see, from the break out of the build there to the bottom, essentially a 22% drop, which those of you that are big investment or Bitcoin investors, you're going to be buying right now. This is the time to kind of get into it because we might see it move all the way down to 53,000, but I'm guessing 58 to 59 is where we're going to kind of ultimately stagger out. And that's just because you'll notice there's volatility right in the middle there. So we're talking about here, volatility here, 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 here. I mean, it makes sense to see that 58 to 59K. 53 is obviously the major support though. So we'll see once if we break below it. But what I'm finding out is that it's basically because Mt. Gox, and those of you that don't know, Mt. Gox was a trading platform that got shut down what was it, like 2017, 2018, and they finally are getting the money back. They're getting their Bitcoins back and such. And what they're doing is now those wallets are now selling because at the time in 2017 versus now, it doesn't really matter if the market's peaking or not. I mean, I want to say it was maybe 20,000 at the most or something like that when it went under, and now they're getting their Bitcoin back and it's sitting at a 69,000. So we saw a lot of Bitcoin move into that. And the reason I'm bringing up Bitcoin is because it's becoming more and more pertinent to the market. It's becoming more and more its own market class or asset class, I should say. And when it moves, it kind of follows the rest of the market in some cases, which is weird because with the S&P ripping, it worked really, the S&P was doing its blow off top or, is stepping into its blow off top phase, and Bitcoin kind of stayed stagnant. And then all of a sudden the S&P falls and so does Bitcoin. So it also makes you wonder how strategically strong it is and if it's actually going to be here in the next couple of months or not. I shouldn't say be here, but it's going to be, what's the value behind it? What's the value behind it, right? Anyways. Now, the next thing that we're going to be paying attention to is today, you guys, I don't really have a set information. Like here's boom, 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 boom. I'm not really following along. I'm just kind of pulling some stuff that I saw this morning that I want to talk about, mainly because it's just good to kind of understand. Sometimes it's not even about being, strategically like today I'm doing this. Here's why this. Sometimes it's just good to know what's going on in the news because all of us still have to live life day-to-day basis, right? So my goal is always just to provide as much value as I can. That doesn't necessarily mean I'm going to always be a structured guy when it comes to videos. But anyways, so the U.S. Treasury is actually projected to buy another 12.5 billion of their own debt this week. Now, this is the beginning of quantitative easing, and they have made some pretty big purchases over the last couple of months in March and April. I don't believe in May, but March and April they did make some pretty big purchases. Basically, what they're doing is they're buying their own debt, and it's kind of crazy because. Look at the maturity date on this one. I don't know. That seems pretty interesting, but basically they're buying the debt for 12.5 billion. Operation date is June 4th, 2026. So that came out today. I'm sorry, yesterday came out. Looks like they're going to be buying it today, actually. Interesting. But when you see that, buying that on brings down the treasury yields. By bringing down treasury yields, it brings down mortgage rates, right? So I think right now they're still trying to create some sort of stimulus because the market is super unpredictable for one, and number two, I think there's a lot less confidence in the market, even though the stock market's absolutely ripping. And I had a conversation with a friend of mine yesterday. We're focusing on getting into more real estate this year, more than anything. That, and we're looking at gold and silver and rare coins, just because, I mean, silver coins, I should say, right? So there's silver involved, but in these types of phases, you want to be in hard assets, especially if they're going to start pushing liquidity into the market. If they start putting liquidity into the market, asset values go up, right? So it depends on what you're putting your money into. See, I'm a Bitcoin and crypto enthusiast always. I am also a gold and silver enthusiast, and I also love real estate, right? So I focus on hard assets, but I also have my speculational assets or speculation assets. The problem that I always witness is is when people over leverage in one factor, right? So the thing is, I feel like everybody feels like they need to have big amounts of money in one asset class or another. But really, it just comes down to how often are you buying into it? What price are you buying in at, right? Because not everybody's going to have millions of dollars. But the thing is, to get started, all you need is $5, $10, $15 at a time to invest, right? He doesn't need large sums of money. I started with $5 and $5 a week or whatever it was at the time. I used to, when I bartended, I used to come home. I used to put $10 here, $5 into an investment fund, $5 here towards gold and silver. I did that for a while because it was like, okay, how can I save some money? And that's how I saved money, right? I just put money there, and then whatever money was left over, I would spend, and that's how I got started. Anyways, so my point is when you're looking at getting into investments, you should be paying attention to what class you're in and why, what asset class you're in and why. And the reason is because when they start buying back Treasury debt, if they start buying it back at a significant amount, which they're buying, large sums as 12.5 billion, but it's nothing that they did pre-COVID or post-COVID. But once they start buying stuff like this, that's where asset prices go up. And we're buying now because of blood in the streets. The market, other than the stock market, I'm still not 100% sold on the stock market. In the recent months, I would want to see a pretty big bear market before I start dumping a bunch of money into it personally. When you see markets move this quickly, this vertical, it does draw major concern for me. But again, it's just because I know what goes up comes down, and I don't really want to be buying something as it goes up. I want to be buying something as it goes down. I've always been in the last 3 years, it's been my mentality. So like Bitcoin is a big one for me, and it dropped pretty significantly over the last couple of weeks. I think 20%. I'll be buying in pretty aggressively starting tomorrow, right? I get paid tomorrow, pay myself tomorrow. I put my stuff into investments right away, some into savings, etc. So that's what we're going to be paying attention to. But what I'm seeing is the Fed is trying to figure out a way to bring interest rates down by creating liquidity. So if they start buying their own debt and not monopolizing it, but creating more liquidity, they'll have the ability to drop the interest rates because you'll see things start to grow. But that's honestly, I have a couple more things to jump into, but really nothing's really bringing an interest to me other than the fact of let's kind of talk about this one. So SpaceX plans to sell approximately 555 million shares at $135 per share in its upcoming IPO, according to new SEC filings. At that price, the offering would raise $75 billion, making it the largest IPO in history by a wide margin. This would value SpaceX at $1.77 trillion. Now, this is something that, again, you're buying into hype at this point. Don't get me wrong, the company's run well and things of those natures, but we're talking about an IPO. IPOs are a little bit different than, matured stocks. IPOs are saying my stock is worth this and here's why. And sometimes those IPOs, most times those IPOs don't return as much as you would anticipate. The insiders who are buying a pre-IPO, those accredited investors that, have the capability of putting $100,000, $200,000, $300,000 into it, they're going to make money on the bell because they already bought them at a discounted price. That's how the pre-IPOs work, right? You invest in a company, you're putting confidence into a company, and then when the bell hits, the retail investor can jump in. It's one of those things that's slightly unfair, but it is how it's just how it works. So my guess is that SpaceX will have a good couple of days, and then it will kind of retrace back to where it should be. I don't believe the company's worth 1.77 trillion. There's not really anything that's given me a reason to believe that. However, I'm sure I'll eat my own words because I know that SpaceX is working on reusable or like commercial based spaceships where basically you can, or rockets or whatever, you can take off, you can land it, and you can reuse it, right? That's like the first time in history. No other company's really done that. So IPOs make me a little nervous. I get it. There's hype behind it. There's excitement behind it. Elon Musk, the richest man in the world. Then you have him starting another company that he's brought a bunch of successful companies. So everybody's going to buy into this. But most people are going to actually eat their own words, and they probably are more than likely going to hold a bag for quite some time if they don't, or they're going to sell at a loss because that's how most people operate. They buy into stocks. They don't have a plan. The stock runs, and then they're like, "Oh, it's going to go up forever," and then they never sell it, and it comes right back down. Now they're holding a bag, or they sell it on the way down and don't make any money anyway, and more than likely lose money. But just be careful of the IPOs. They're not always going to be a great idea. They're not going to be a great thing you should be doing. But last thing I'm going to touch on is we Michael Burry is somebody that I pay attention to. And right now, Michael Burry is short Nvidia 1 million shares. His case: 3 customers now own 64% of receivables, and the biggest is paying slower while buying less. The same 3 are building their own chips to need it less. He calls it a finger on the trigger. So basically what's going to happen is with this company is if these 3 people stop buying and start selling, they're going to be selling. There's 64% is what they own. 64%, that's a lot to own. That's Again, I'm not a big fan of Nvidia anymore either. I mean, it was great at the beginning in 2017, 2018 when it started taking off, but you're up thousands of percent at this point. Buying into this, it's not a great idea. I know people are buying into it just because it's all over the news and people pay attention to it. But the thing is, when you're looking in stocks, you should be buying stuff that doesn't exist on news headlines and things of yet. Because when you buy into something like that, the way that it's structured, there was a slim can, I think it was, is what it was called. There was a book I read where basically it has to meet a certain criteria to buy into it. Now, the one thing I know, it doesn't matter if you are a macro investor, it doesn't matter if you're a technical investor, you know that you don't buy at the peak of green candles. You buy in red candles, right? So right now, my guess is that Nvidia is probably going to see its darker days over the next few years, especially if China starts to attack Taiwan. We'll know more about that later on down the line. But all I had for you guys today was a few scattered articles, nothing crazy, nothing structured, but I just wanted to get on here and talk a little bit today. So I appreciate you guys watching. Make sure to like and follow, and we'll see you tomorrow.